Vodafone's full-year numbers looked clean on the surface. Total revenue up 8% to 40.5 billion euros, organic service revenue growing 5.4%, a 500 million euro buyback announced. The market briefly rewarded that, then immediately took it back, because adjusted earnings missed consensus on results day before recovering through the week. That sequence, miss, recover, institutional attention, signals the market is not pricing the headline, it is pricing the condition underneath it. That condition is Germany, and the weight of it is structural, not incidental. Germany contributed 37% of group adjusted EBIT LL in FY26, and that segment saw organic service revenue fall 0.2% and adjusted EBIT LL drop 3.3%. A 3.3% decline in a segment that holds more than a third of group earnings power is not a rounding error. It is a drag large enough to suppress the valuation multiple, even as the rest of the business accelerates. The mechanism behind the German deterioration is specific enough to be verifiable: the MDU transition, referring to changes in bulk TV contracts for multi-dwelling apartment buildings, compressed revenue in a segment that Vodafone cannot exit quickly. That is a regulatory and contractual unwinding, not a competitive loss, which matters for how investors should frame the timeline. A competitive loss can accelerate. A contractual unwinding has a floor. Management called this a new chapter for a simpler company well set for midterm growth, language that is deliberately forward-looking, but which leaves the current year earnings structure exposed. The FY27 guidance range of 11.9 billion to 12.2 billion euros in adjusted EBIT LL implies roughly 4 to 7% growth from the FY26 base of 11.4 billion euros. That range is only achievable if Germany stops declining, because Africa and the UK cannot arithmetically compensate for further deterioration in a 37% segment. What the guidance does not resolve is whether Germany has already found its floor.
The Vodafone 3 integration in the UK is the part of this story that changes the earnings structure in a way the headline revenue growth does not fully capture. Vodafone agreed to buy CK Hutchison's remaining 49% stake in Vodafone 3 for £4.3 billion, moving from joint venture economics to full consolidation of a business with more than 28 million customers. That makes Vodafone 3 the UK's largest mobile operator by customer count, and it means the UK segment transitions from a partial earnings contribution to a full one. The capital deployment logic here is consequential: £4.3 billion directed at full UK ownership, funded against a backdrop of adjusted free cash flow of €2.6 billion and a concurrent €500 million buyback. Vodafone is simultaneously returning capital and acquiring it, which signals management confidence in cash generation, but also compresses future optionality. The buyback and the acquisition together imply the balance sheet is being managed tightly. Any German deterioration beyond current guidance would force a choice between that buyback commitment and debt headroom. A non-executive director bought 50,000 shares at £1,14365 on May 13th, the week of results. Insider purchases at this size are not material to earnings, but as a countersignal they register. Someone with board-level visibility on the German trajectory chose to add exposure at current prices. That does not resolve the Germany question, but it recalibrates the probability distribution around how bad the floor actually is. The UK consolidation also changes the competitive picture in a way that feeds back into valuation logic. A fully owned 28 million customer base in a consolidated 2 to 3 player UK market generates pricing power that a 51% joint venture does not. BT and Sky are the reference competitors. The question for capital allocation is whether the £4.3 billion purchase price reflects a valuation that already prices in that pricing power, or whether it represents a discount to the synergy case management is building. Quilter Cheviot's Matt Dorsett flagged Germany as the key drag, not the UK, which implicitly acknowledges the UK case is already partially credited. That asymmetry is where the next leg of the thesis lives.
The 5G fixed wireless access relaunch is the event most institutional coverage treated as a product update, but the capital flow implication runs deeper than that. Vodafone relaunched 5G home broadband with unlimited data and plans starting at £21 per month on a 24-month basis, targeting homes underserved by fiber, a segment that disproportionately overlaps with rural areas, where Vodafone already holds spectrum and tower assets that are not generating residential revenue. The structural insight is that 5G fixed wireless access monetizes excess network capacity without requiring incremental capital expenditure on new spectrum or new towers. The infrastructure already exists. The product is a software and routing layer on top of it. In a period where Vodafone is deploying £4.3 billion on the UK acquisition and managing a tight free cash flow envelope, incremental revenue that draws on sunk costs rather than new capital changes the marginal return profile of the existing asset base. The European Edge Continuum initiatives, announced at Mobile World Congress in February and involving Deutsche Telekom, Orange, Telefonica, and Telecom Italia, adds a second layer to this asset monetization logic. The federated edge approach covers approximately 55% of Europe's population, targeting multinationals and large public sector organizations that need application consistency across borders, with data sovereignty preserved. Vodafone's Malaga lab is the validation point, with customer trials planned over the coming months. The cross-domain coupling here is the one most likely to be underweighted. The same 5G infrastructure that delivers fixed wireless access to rural homes is the physical substrate for the edge compute nodes that enterprise clients would deploy applications on. Vodafone is not building two separate businesses. It is layering two revenue streams onto one capital base, and the enterprise edge stream carries structurally higher margins than residential broadband. If that layering works, the valuation logic shifts from a pure telecoms multiple towards something that partially prices infrastructure as a service economics. That re-rate is not in the current price, and it is not in the FY27 guidance range either.
The scenario analysis for Vodafone ultimately collapses to one binary condition: whether Germany organic service revenue stabilizes, meaning it stops declining, within the FY27 guidance window. Everything else in the thesis is supportive but insufficient on its own. Africa is growing at 12.9% organic service revenue, with M-Pesa up 23.1% and Vodafone Cash in Egypt up 48.2%. But Africa's contribution to group EBITDA AAL cannot arithmetically offset a continued 3% decline in a 37% segment. The UK consolidation adds earnings power, but that is already partially reflected in the £4.3 billion acquisition price. The 5G fixed wireless access and edge infrastructure plays are medium-term margin contributors, not FY27 earnings drivers. The FY27 guidance range of $11.9 billion to $12.2 billion is only the floor of a recovery, not the ceiling of an acceleration. The MDU contract unwinding in Germany has a contractual floor. It ends when the bulk TV agreements expire and are not renewed. Management has not given a specific timeline for when that drag becomes neutral, which is the piece of information that would allow investors to model the inflection point rather than the trajectory. The absence of that timeline is the most important gap between the guidance language and a position reconsideration trigger. The insider purchase at 1.14365 introduced at the open of this analysis is the checkoff anchor. That price level is now the reference point against which the Germany stabilization thesis gets tested. If German service revenue turns flat or positive in the H1 FY27 update, the case for buying into that insider signal is confirmed. If the MDU drag extends into a second consecutive year of decline, the insider's timing was wrong, and the 37% problem reprices the stock below that entry. The Africa growth and UK consolidation are real, but they are the supporting case, and Germany is still the main thread. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.